If I told you there was a life insurance product that required you make one and only one premium payment, and then you never had to worry about it ever again, would you be interested? That is the general appeal of single premium life insurance. And there are others who believe that because you're making one substantial payment all up front, it must be the best way to optimize the cash value rate of return on a life insurance policy. But you'd be wrong if you made that assumption. Hello there. I'm Brandon, founder of the Insurance Pro blog and licensed insurance agent. Single premium life insurance has had an on-again, off-again relationship with the life insurance industry, as a number of companies tend to have a fickle opinion on whether or not it meets their profitability objectives. That being said, it almost always is the case that at least somebody is out there manufacturing the product, and the broad appeal towards single premium life insurance is its perceived simplicity and the idea that somehow that large payment is going to be the greatest way to extract value in terms of greatest rate of return you could possibly get on the cash value inside a life insurance policy. I'm here to tell you that's simply not true. Throughout my years in the industry, it has always been my experience that with some finesse, we can get ordinary life insurance policies to perform far better than single premium life insurance products. And I've even come here today with some real examples to show you how single premium scenarios fail to exceed the ultimate value we can extract from well-designed, manipulated, if you will, ordinary life insurance policies. We'll look at those examples in just a little bit, but let's start with some more fundamental elements that are important to understand when it comes to single premium life insurance policies and their various consequences and implications. While single premium life insurance may seem on its face incredibly uncomplicated, I assure you, there are a number of details lurking beneath the surface that make the product far more involved than you probably ever imagined. First and foremost, by definition, all single premium life insurance policies are also modified endowment contracts. This means they lose several of the highly attractive tax features that regular life insurance policies enjoy every single day. In addition to that, having MEC status means if you decide later on you don't like your single premium life insurance policy and you would like to transfer its cash value to a new life insurance policy via the 1035 exchange, you will create a new modified endowment contract with that new life insurance policy, even if it wouldn't normally violate the MEC test. So by virtue of buying a single premium life insurance policy, you've backed yourself into a corner regarding modified endowment contract that you cannot get out of without fully surrendering the policy and essentially starting all over again. We're going to get into the details of the numbers that I mentioned earlier, but before we do that, I want to give you a basis of understanding of how these were put together to make the comparison that we're about to go through. Today, in 2025, the marketplace for single premium life insurance is kind of mediocre at best, but we can use companies' regular life insurance policies and effectively turn them into single premium life insurance policies. And in fact, when we do that, they perform far better than a bona fide single premium life insurance policy. So that's what we're going to do to make this comparison, because we're trying to give single premium life insurance as best a leg up as we can. We're going to assume a male age 45 who has $250,000 he would like to put into life insurance immediately. We're going to look at how cash value has accumulated 20 years out and what sort of income we could generate from the life insurance policy. We're then going to compare the results of the single premium life insurance policies against ordinary life policies that have been designed in a way to optimize a lump sum of money, the $250,000. We're going to use the withdrawal rates that we normally use for life insurance policies when used as a retirement asset. There's something to be said about this assumption, but I'll get into that after we look at the numbers. We're going to start with the single premium universal life insurance policy. It happens to be a single premium index universal life insurance policy so that we can compare it to an ordinary index universal life insurance policy afterwards. So we make one single $250,000 premium payment in year 1, and then we make 0 premium payments after that. In year 20, we have $751,124,000 in cash surrender value. If we think about the income, the gross income that this is capable of generating using 6% as the withdrawal rate, which is pretty typical when we look at income scenarios from index universal life insurance policies, just regular index universal life insurance policies, we would be able to generate $45,067 from this policy as income. But remember, this is a modified endowment contract because it's a single premium policy, which means all $45,067 is going to be recognized as ordinary income, which means we have to pay income taxes on it. So if we want to think about this in terms of the after-tax income that it's capable of producing for us, assuming our 20% income tax rate that I mentioned already, that means our after-tax dollars, what we get after we're done paying income taxes on this, that comes out to $36,054. $45,000-ish is what we get gross, but $36,000 is what we're going to net out of this policy in income after we're done paying taxes. Next up, let's look at an ordinary index universal life insurance policy that we have simply short paid. We've taken the $250,000 and we've broken it up into 4 equal payments going into the policy, and then we stop. There are no future premium payments made after that. We go out to year 20. We look at cash surrender value. It's $616,702. That's fewer dollars than we had under the single premium scenario. Quite a few fewer dollars, in fact. But if we look at the generatable income from this using 6% as our withdrawal rate, we're now going to have $37,002 in generated income from the policy. As a reminder, the net after-tax income that we got from the single premium policy, that was $36,054. So we get less money out of the single premium net after tax than we get out of the ordinary universal life insurance policy. And this is assuming a 20% effective tax rate. If it's higher than that, that means we're going to net even fewer dollars in actual income from the single premium scenario. Now let's take a look at the single premium whole life scenario. $250,000 year 1, nothing after that. We look at year 20. We have $597,059 in cash value in the policy. Whole life insurance, we typically don't recommend withdrawing as aggressively against. 5% is the number here. So if we want to look at the gross income that this would produce for us, that number is going to come out to $29,858. So $29,858 is the gross income we would get. Again, this is a modified endowment contract, so we got to think about this in terms of after-tax dollars. So once we apply our 20% effective tax rate, the actual income that we would net out from this is $23,886. So $29,858 gross, $23,886 net income from this single premium whole life scenario. Now we're going to compare it to an ordinary whole life policy that we have, again, short paid. This time we're doing it over 5 years, 4 years with index universal life insurance, 5 years for whole life insurance. Sometimes they differ a little bit. That's fine. We worked out the optimal scenario here. We get to year 20. We have $488,411. Again, less than the single premium scenario by quite a bit. But if we apply that 5% withdrawal rate for the sake of income, what we can generate income-wise from this policy is $24,421. And again, this is a life insurance policy. It enjoys all of the great tax features that ordinary life insurance gets. So we don't have to worry about netting out after tax. We get more money out of this situation in terms of income than we get from the single premium life insurance policy. And as a reminder, that was $23,886. So again, the ordinary whole life policy is better than the single premium whole life policy, just as the ordinary indexed universal life insurance policy produced more net income to us than the single premium indexed universal life insurance policy did. So in every scenario, comparing both indexed universal life insurance, single premium and ordinary life insurance, and whole life insurance, single premium and ordinary life insurance, we see that the net generatable income we get out of the policies is higher when we use ordinary life insurance versus a single premium scenario. The idea that we somehow overwhelm rate of return by putting extra money into the policy at inception, despite the MEC status, simply doesn't hold true, because the tax benefits of regular life insurance create a higher net effective distribution from the policies. But there are several other applications or considerations that we have to bring up in order to fairly discuss this whole thing. And it starts to show us that the advantage of ordinary life insurance policies versus single premium life policies is even greater than that analysis showed. First, I assumed the same withdrawal rate for the single premium policies as the ordinary life policies. The single premium policies being modified endowment contracts makes those withdrawal rates somewhat iffy. The reason being, income, or really any distribution taken from a modified endowment contract, carries an ordinary income implication and therefore tax liability to the degree that gain is being distributed from the policy. And with modified endowment contracts, all gain must be removed before cost basis can be touched. Now, when it comes to modified endowment contracts, all distributions are ordinary income, even distributions you don't necessarily touch yourself. What I mean by that is, loan interest is viewed as a distribution. So if you have a modified endowment contract and you take a policy loan against it, any loan that accumulates, including interest that is added to the loan, is recognized as a distribution, which means you have to recognize it as ordinary income, and you will face an income tax liability on that. This is money that you yourself will never receive. It will simply add to the loan balance outstanding against the modified endowment contract. But you will absolutely see that money added to any distributions you yourself did get on your 1099. You must report it to the IRS, and that will be part of the calculation that arrives at your ultimate income tax liability for the year. This creates a colossal income tax problem for people in certain situations. And it's for this very reason that we never recommend people with modified endowment contracts take income distributions in the form of policy loans. Now, because all distributions for income are coming in the way of withdrawals, I don't know that our withdrawal rates will necessarily stand the test of time when it comes to the single premium scenarios. The reason being, the math that supports the withdrawal rates for life insurance that we have always used, 5% for whole life insurance, 6% for indexed universal life insurance, takes into account the fact that policy loans are pretty heavily used in these situations. The benefit behind policy loans is the fact that the cash value inside the life insurance policy remains there and it continues to grow. That means that in absolute dollars, the pile of cash that represents cash value is typically growing at a higher rate than the loan balance because the cash value is larger than the loan balance for all of the policy's existence. even if the loan rate is higher than the rate of return expected on the cash value. The sheer difference in size of cash value to loan balance means that cash value will, at least for quite some time, grow at a faster rate than loan balance. That's what supports the higher withdrawal rates that we quote from both whole life and indexed universal life insurance than your typical 4% withdrawal rate for the market. If the loan aspect is removed from the scenario, I can't say that I'm confident that that withdrawal rate necessarily stands as a good idea, which means the net after-tax income that is generated from the single premium life insurance policies may actually be less than what we saw in that scenario that we just looked at. But there are other issues when it comes to the fact that distributions are, for the most part, going to be taxable when they come out of single premium life insurance policies. For starters, if you take a distribution from a modified endowment contract prior to age 59 and a half, there are additional penalty taxes that are assessed on that, just like there are on regular retirement style accounts. The fact that distributions from a modified endowment contract are counted as ordinary income, again, so long as it's gain coming out of the policy, means that it could push you into a taxable situation for Social Security. It also makes taking lump sum distributions much more complicated because it could push you into an ever higher tax bracket. And it also makes the task of changing income from the single premium life insurance policy dynamically, as we like to call it, much more complicated. We have had discussions at the Insurance Pro Blog and on the Insurance Pro Blog podcast about the resiliency and the uniqueness of life insurance and its ability to provide an ever-changing income number to meet different needs in retirement. You can dial it up and dial it down, and it generally doesn't hurt the policy, and it is far more resilient at accomplishing that task than a number of other retirement assets people typically hold. But when the distributions are taxable, dialing up the income amount from the single premium life insurance policies, that becomes a lot more complicated because of the tax liability implications. So while the rate of return may look more attractive when we simply look at it as cash value accumulated in any given year, once we factor in more refinements that really speak to real life and how people would actually have to use these policies, rate of return is a slightly more nuanced discussion, and we find ordinary life insurance has a huge advantage over single premium life insurance due solely to the fact that single premium life insurance is always a modified endowment contract. But if you like the ideas of single premium life insurance, there are ways to effectively accomplish what single premium life insurance is doing with ordinary life insurance. It is possible to write one single check to an insurance company and no more, and have the policy function as the ordinary life policies that I showed you in my examples work. So you can effectively get the simplicity of one payment and no more, and get the benefits of ordinary life insurance, its tax features, and its better way of addressing a number of financial objectives if you're trying to use the cash of your policy. And I know there's a group of people out there who are going to look at these situations and say, you could have taken the $250,000 and put it in the market and had so much more money. Good for you. Keep doing you.